So TD Bank just froze $480 billion in U.S. linked assets, and the American financial system is seizing up in real time. That is not a typo. $480 billion. That's more than the entire GDP of Louisiana, Kentucky, and Iowa combined, locked inside a Canadian banking system that was just told by the President of the United States that it is no longer welcome on American soil. Within 48 hours, overnight interbank lending rates spiked from 5.3 to 7.1%. Mortgage approvals collapsed, auto loans froze, and 9.6 million American customers who bank at TD branches from Maine to Miami woke up wondering if their deposits were safe. And when Warren Buffett, the largest single shareholder of Bank America, finally spoke about it, he didn't raise his voice. He never does. He just held up a single page of interbank lending data and said 7 words that are still ricocheting through every trading floor on earth. The plumbing is broken. We broke it. Subscribe now, because this is the story of how a 35% financial services surcharge triggered a $387 billion banking stock massacre, froze credit for millions of American families, and why the smartest investor alive says the liquidity isn't coming back. Let's walk through this, because the mechanics of this crisis are invisible to most people, and that's exactly what makes it so dangerous. Monday, 10 a.m., the President signs Executive Order 14-2038, the American Financial Sovereignty Act. It imposes a 35% surcharge on all Canadian financial services operating in the United States and authorizes the Treasury Department to begin a review process for potentially revoking the U.S. banking licenses of Canadian institutions. At the signing, Trump names them directly: TD Bank, Harris, RBC Capital Markets, and calls them foreign banks that have been draining American wealth for decades. He promises that American money will stay in American banks, managed by American bankers for American families. The applause line lands, the cameras flash, and inside the headquarters of every major Canadian financial institution, the crisis protocols activate simultaneously. Here's what most Americans don't know about their own banking system, and what makes this executive order so catastrophic. The American financial system is not American. It is North American. It has been for 40 years. Canadian banks aren't foreign guests in the U.S. economy. They are load-bearing walls. TD Bank operates 1,100 branches across the American East Coast. 1,100. That's more U.S. branches than Citizens Bank, more than Key Bank, more than Regions Financial. TD holds approximately $280 billion in U.S. assets. It serves 9.6 million American retail customers. These aren't wealthy Canadians parting money in offshore accounts. These are teachers and nurses and small business owners in New Jersey, Florida, Pennsylvania, and the Corollas who chose TD because it was the bank on their corner. Owns Harris Bank, 500 branches across the Midwest and Mountain West. RBC's Capital Markets Division is one of the top 10 investment banking operations in the United States by deal volume. Combined, Canadian banks hold roughly $480 billion in U.S.-linked assets and are deeply woven into the interbank lending market. The overnight system, where banks lend to each other to maintain required reserves and keep the entire financial system liquid. This is the plumbing, and the President just took a sledgehammer to it. Tuesday, 8 a.m., Ottawa, Canada's Office of the Superintendent of Financial Institutions, OIFI, issues a single regulatory directive. It is 4 paragraphs long. It contains no emotional language, no political rhetoric, no mention of the President by name. It simply instructs all Canadian chartered banks to reduce their U.S. interbank lending exposure by 60% over 90 days and to haul all new cross-for credit facilities effective immediately. Mark Carney holds a press conference 30 minutes later. He speaks for less than 2 minutes. Canadian financial institutions will comply with all U.S. regulations, including any new surcharges. Simultaneously, we have a fiduciary duty to protect Canadian depositors and shareholders from regulatory uncertainty in foreign jurisdictions. OSFI's directive reflects that duty. We are simply managing risk. No threats, no insults, no counter-tariff, just 4 paragraphs of regulatory language that are about to detonate the American lending market. Here's how interbank lending works. Because if you don't understand this, the rest of this story won't make sense. Every night, banks lend money to each other. Banks that have excess reserves lend to banks that are short. This is how the system stays balanced. It's called the federal funds market, and it moves roughly $100 billion per night. The interest rate on these overnight loans, the federal funds rate, is the single most important interest rate in the American economy. It determines what you pay for your mortgage, your car loan, your credit card, your small business line, the credit, everything. Canadian banks are major participants in this market. Now, because they're doing America a favor, because it's profitable, they park excess capital in overnight U.S. lending markets and earn a safe return. It's mechanical, it's boring, it's also essential. When OSFI tells Canadian banks to reduce U.S. interbank exposure by 60%, approximately $38 billion in overnight lending capacity begins to drain from the system, not in a crash. In a slow, methodical withdrawal, as contracts mature and are not renewed, the effect is immediate. Tuesday night, the effective federal funds rate, which the Fed targets at 5.25 to 5.5 to 5.55, prints at 5.87%. By Thursday, it hit 7.1%. The Federal Reserve hasn't changed its target. The market has simply run out of willing lenders. There aren't enough dollars in the overnight pool. Interest rates are rising not because of monetary policy, but because the plumbing is draining. And now the dominoes fall on Main Street. Wednesday morning, mortgage lenders begin repricing. The average 3-0-year fixed mortgage rate, which was sitting at 6.4% on Monday, jumps to 7.3% by Friday. For a family buying a $350,000 home, that's an additional $214 per month in mortgage payments, $77,000 more over the life of the loan. The National Association of Realtors reports that mortgage applications dropped 31% in a single week. Home sales, which were already sluggish, effectively freeze in the Northeast and Midwest, the regions with the heaviest Canadian banking presence. Auto lending seizes next. The average auto loan rate spikes from 7.1% to 8.9%. Auto loan approval rates drop 23%. Dealerships in Pennsylvania, Ohio, and Michigan, states where Harris is a major auto lending underwriter, report that customers are walking out when they see the new monthly payment numbers. A $40,000 truck that cost $780 per month last week now cost $867. For a working family, that's the difference between buying and walking away. Ford and GM report that dealer inventory is building. Cars are sitting on lots unsold. Ford shares drop 8.2%. Small business credit lines, the lifeblood of the American economy, are hit hardest of all. Regional banks that depend on Interbank borrowing to fund their small business lending portfolios are suddenly paying 60 to 90 basis points more for capital. They pass it on. A restaurant owner in Jacksonville who was paying 8.5% on her $200,000 credit line gets a letter. Her rate is now 9.9%. Her monthly interest cost just jumped by $233. Multiply that across 6 million American small businesses, and the cumulative credit tightening is estimated at $47 billion annually. Friday, the stock market delivers the verdict. The S&P 500 financial sector drops 11.4% across the week. The worst weekly performance since the 2023 regional banking crisis. JP Morgan falls 7%. Bank of America falls 9.2%. Wells Fargo falls 8.8%. But the regional banks are slaughtered. KeyCorp down 16%, Regions Financial down 14%, Citizens down 18%. Total financial sector market capitalization destroyed $387 billion. This isn't about Canadian banks doing anything wrong. The problem is that the interbank pool they operate in just lost 60% of its Canadian capital. And here's the irony. It hits close to home. TD Bank's 1,100 U.S. branches are concentrated in suburban and rural communities along the East Coast, many of them Trump strongholds. Now, 9.6 million Americans who rely on those branches face potential disruption, not because TD wants to pull back, but because the regulatory uncertainty created by the executive order makes expanding U.S. operations financially irrational. TD immediately announces a freeze on all new branch openings and a strategic review of its American footprint. Translation: they are seriously considering leaving. If they do, nearly 10 million Americans will have to find a new bank. In many communities, TD was the most convenient option, a financial displacement event of historic scale. The impact hits even closer to home for the Trump Organization. Heavily leveraged in commercial real estate loans syndicated across multiple banks, including Canadian institutions. As interbank rates spike, the cost of servicing these loans jumps. The Trump Organization's annual borrowing costs increased by an estimated $14 million overnight. The man who signed the order to punish foreign banks is now paying more to his own lenders because of it. 8 days after the executive order, Warren Buffett speaks. No podium, no audience, just a camera and a single sheet of paper showing the federal funds rate over the past week. This piece of paper shows the overnight lending rate. He begins. It was 5.3% 8 days ago. It's 7.1% today. The Federal Reserve didn't raise rates. Nobody at the Fed did anything. What happened is we told $480 billion in Canadian capital it wasn't welcome here anymore. That capital started leaving. And when capital leaves, the cost of borrowing goes up for everyone, not just banks. Your mortgage, your car loan, your small business line of credit, everything. Buffett sets the paper down. People think of banks as buildings with vaults. They're not. A bank is a pipe. Money flows in one end from depositors and out the other end to borrowers. Canadian banks were very large, reliable pipes in the U.S. system. We just told those pipes to shut off 60% of their flow. Now there's less money flowing to borrowers. When supply drops, the price goes up. Econ 101. It's just arithmetic. He pauses. Is this temporary? No. When you introduce regulatory uncertainty, capital doesn't wait to see if you were serious. It moves. Canadian banks are already redirecting capital to Europe and Asia. HSBC London, Deutsche Bank, they're welcoming it with open arms. Once that capital finds a new home, it doesn't come back. The pipes are being rerouted, concrete poured over old connections. Buffett leans forward. I own more Bank of America stock than any individual on earth. This policy is costing me personally. But what keeps me up at night is the nurse in Tampa whose mortgage auto pay may not clear, or the restaurant owner in Philadelphia whose credit line just became unprofitable. They didn't ask for a trade war with Canadian banks. They just needed the plumbing to work. And someone who doesn't understand plumbing smashed it with a hammer and called it sovereignty. Here's what happened in one brutal week. Donald Trump imposed a 35% surcharge on Canadian financial services and threatened to revoke U.S. banking licenses, calling foreign banks parasites in a system they've been load-bearing for 40 years. Canada's financial regulator responded with 4 paragraphs of calm, unemotional guidance, forcing banks to withdraw $38 billion from overnight U.S. lending pools. Interbank rates spiked from 5.3% to 7.1%. Mortgage approvals collapsed 31% in a single week. Auto loans and small business credit lines froze. $387 billion evaporated from U.S. financial stocks. TD Bank customers, 9.6 million Americans, faced financial uncertainty. The Trump Organization's borrowing costs jumped $14 million overnight. The mortgage rate, 6.4% last Monday, 7.3% today. That's not Canada's fault. It's the cost of arithmetic illiteracy written on every monthly statement in America.